All right, Matt, take it away.
Okay, well, hello, and thank you for everyone for tuning in. I appreciate it. My name is Matt Burk. Welcome to Fundamentals. Today I am here with Ray Mazzie, and we're going to highlight a story from Ray, who's one of our clients, and hopefully help demonstrate to other people in this business how at least one best-in-class ground-up developer of rental housing scaled his business to over 2,100 units, total value in excess, I think, of $600 million in just 3.5 years. And encourage you to ask questions along the way. Please type them in the chat box or flag yourself, and Kylie will let you know. But we'll do our best to answer them throughout the conversation, and we'll have some Q&A here at the end. So with all that, Ray, appreciate you coming on the show. Thanks for being here today.
Yeah, no, thanks for the opportunity. It's good to be here.
Yeah, well, I'm looking forward to the conversation. I know we had a chance last week to catch up a little bit and kind of prep for the call, and super interesting kind of hear about your story. So interested to have the audience learn a little bit about that. Maybe you can tell us a little bit about your journey as a fund manager. I know you kind of came from maybe a little bit of a different background than a lot of folks might who get into this business. So tell us a little bit about your story and how you got into it.
Yeah, so again, thank you. So I started out, or I should say we started out, my business partner and I, Dean Myro at Southern Waters Capital, as actually a credit strategy. So we were a hedge fund from the beginning, and we happened to be participating in a lot of debt instruments that were real estate-backed assets or securities. So fast forward like a year and a half, we focused the firm completely on ground-up development. But prior to obviously having us in a hedge fund structure was called for us to have to use fund administrators. And I had the awesome opportunity of learning that, kind of learning that process. It was like drinking water through a fire hose. There's tons of different types of fund admins out there, both in level of service and level of quality, and definitely different types of pricing structures. But it was a whole world that you kind of don't really realize exists, kind of servicing the fund itself. Obviously, fund administration kind of being the nexus to all the services that the fund needs just to be maintained and things of that nature. So admittedly, after we kind of shifted our strategy, I was excited to not have to deal with fund administrators as much as I did due to the amount of transactions we were doing when we were running this operation as a hedge fund. Obviously, there's a lot more transactions than we were doing ground up development. So long story short, it was fun to not have to deal with a lot of fund administrators for a certain period of time, but we grew very quickly and we realized we had to step back into that space. And I was delighted when I came back in to find out that it's not exactly as I perceived it to be when I first got into the business. So
yeah, well, most people get into the real estate fund business so that they can have to deal with fund administration. Certainly not my experience, but tell us a little more, Ray, about, I want to dig deeper on you came from a hedge fund background. I think a lot of people I've met over the years that we've worked with really came from either, I'll call it bottom up or top down on the real estate side. Either, started off buying, flipping houses, maybe doing hard money loans. Some people starting at bigger private equity shops and then going out and hanging out their own shingle. But kind of what's the difference in your mind between like the hedge fund and then how did you pivot into the real estate space? And I understand you have a legal background as well, so maybe you can.
Yeah, so I guess it would help to, sorry to cut you off. It'll help to give like a quick background. So I graduated from law school and business school and spent a short period of time working for the governor here in the state of Florida, and then came down to South Florida to actually work at a startup where I met my now business partner, who is a seed investor in that operation. So after my equity vested there, we had an awesome conversation about me wanting to do my own thing, and we had become great friends. Dean was a mentor to me, and I'm now blessed to have him as a business partner. So I have a non-traditional path to the real estate world, but as I was working for Dean and with Dean at my former company, when I first moved down here, I did a significant amount of real estate transactions, both with government entities, research universities, farmers, just very unique stuff that made it really obvious that I could navigate the bureaucratic system, if you will, and I understand real estate value. And obviously having somebody like Dean next to me who's got 30 years from Wall Street. Doesn't hurt. So, he's got a background in underwriting project finance. He sold his investment bank and broker dealer to BB&T in 2005 after he came out of law school in 1993. So from then on, he ran, or from 10 years after that, he ran BB&T's project finance and capital markets nationally. So he's forgotten more than I've yet to learn. But between our two expertise and legal backgrounds, it was kind of a natural transition. We basically went from kind of being in the more ivory tower, for lack of better terms, to being more boots
Yeah.
on the ground. And that's kind of how the transition happened, and was a little bit easier and that's obviously a relative term. There's nothing easy in ground up development, but a little bit easier of a transition. So that's how I ended up in the real estate space in the first place. And
Yeah.
you're right. A lot of people usually start smaller just because they're either capital constrained or time constrained or both, or opportunity constrained with access to one of those two things. So I was just lucky enough to have people who believed in me, and then was smart enough to leverage those people and other people I knew to find an opportunity worth investing in. And when you're around people like that, they understand going small isn't necessarily uh, less risky. It's just different. So as long as you can show an adequate risk profile for the capital that you've been able to attract,
Yeah.
and the opportunity looks good, then they'll run at it. So that's why I was lucky enough to kind of start big. But as one last side note, when I did start out like everybody else. When I was in my last year of law school, I bought a little townhouse with a friend. I never really tell this story. Bought a little townhouse with a friend. I scraped every penny we had together to buy it. And we bought it on floating rate debt, like all things I wouldn't do now. But I was lucky enough to exit that thing right before interest rates started popping up in the last couple of years. And it was funny, as I sold my first unit I ever bought, I had just put my 1000th unit under contract. So just goes to show you, the power of the mind. It'll help you expand or it'll keep you small. It just depends on how you use it.
Yeah. Yeah. That's a great story, man. So, like, how did you guys then, as you get into the real estate space and you start raising capital, describe sort of the investor side of the equation? How do you guys raise the money? Are you guys doing them syndicated, kind of one deal at a time? You do them in a pool format? Talk a little bit about that.
Yeah. So it's a little bit of both. In the beginning, we were able to have some pooled funds because the hedge fund was kind of winding down, and we were able to identify assets during that period. But then from then on, we actually, realized from an investor standpoint and an operating standpoint, it's better to have the assets separated if you can, and if you basically want to spend more time looking for deals instead of looking for capital, you kind of do the syndicated route as opposed to the fund route where you have a pool of capital kind of sitting at the ready. If you've got more team members who can tackle those things at the same time, that's great too. But I just found, I had a lot more traction and excitement when I had a deal in hand, as opposed, especially at my age and track record, as opposed to going out and saying, "Hey, here's what I'm gonna do," and set your money aside for something I've never done before. It was just easier to kind of shift the strategy to a more syndicated model. But as the as we go down the path here, there's certain talks that we've been having about putting together a smaller kind of co-GP fund for just uh, I guess pursuit capital, or just kind of jumping on unique opportunities that come by. So short answer is, for now, it went from pooled to syndicated, and it may go
Yeah.
from just syndicated to syndicated and pooled at a later date. So
Yeah, well, my experience is that there's a lot of different ways to skin the cat. Sometimes it's syndications work great. Sometimes the fund works better. Some depends on the individual. Depends on your
it's
ability to
totally
raise
personal.
capital.
Yeah, I think it's totally, like, first and foremost, like, what are you best at, right? If you're better at finding deals than you are finding capital, then go for the deals first, right? That's the simplest way to think about it. But if you're still better at finding deals, but you have access to a bunch of eager capital that trusts you and you have a track record, then maybe it is better to just pool up some funds so you can act quickly. I think it comes down to, like you said, the actual person and their skill set, and then their business and where it is in the life cycle, and then again the markets too, right? It's not easy to raise a pooled fund when markets are shifting. But if you have the right track record and for being, successful in a shifting market, then it's easier. So, just like you said, there's 1,000 ways to skin the cat. It really depends on you, your business, and then the business cycle you're in.
Yeah, I think people ask me all the time, what's better, fund syndications? I said neither is inherently better or worse. They're just different. Both have advantages and disadvantages, and it really depends on circumstances and individuals. But it's
Yeah.
interesting to see that you've done more of the syndications, and even then you have found the administration piece kind of a valuable. Maybe a little bit about. I appreciate the origin story. Maybe give us a little bit of the perspective around kind of what have you found on the administration side that Verivest does for your business, and how has that helped you out, and what is the value prop that you're seeing there?
Yeah, definitely. I mean, it's not only administration, because I think, like you said, administration on a syndicated level isn't too much of a burden, as much as I still don't want to do it. But really, it's the investor relations arm of your guys' business or Verivest business. It really does. It really is nice to just not have to. Sometimes you got to spend anywhere from 30 minutes to an hour walking an investor through through some paperwork or through a process. And then, as a former attorney, I always get uncomfortable when I have to start walking people through stuff. It just feels like my old attorney hat goes on. I'm like, I really don't want to be giving you advice. I really don't want to be showing you anything. I've explained enough and it's all there. Read it with your attorney kind of thing. But then you have to, it's a fine line. You don't want to leave your new investor on an island and be like, hey, I sent you the documents, figure it out. That's not. So it's nice to have Verivest to basically organize everything in a manner that makes it, step by step. And then when they run into an issue, at least you know exactly where they are in the process. That's always a hard part too, right? Somebody who's like, hey, I'm having an issue with this or that, and you really don't know where they are or what they've read or what they haven't, or you kind of just know where the confusion lies, somewhat. So anyway, in a short sense, Verivest organized the process. So when there is an issue, you know exactly where it is, which makes it easier to solve, not only for me, but also then for Verivest. And at a basic level, it's just nice to only have to shoot off an email or two and then maybe pick up a phone call. And I know everybody's being taken care of extremely quickly, because that's, it's hard enough to get somebody to agree to give you a large sum of money. You don't want to make it difficult for them to send the funds. So,
Yeah.
you know, at the end of the day, the onboarding process is super awesome, that I've experienced thus far. And second to that, anytime I've ever had an issue, which really, I don't think one of them has been Verivest originated yet. It's kind of been just getting used to, having older investors getting onto a more technically savvy platform, especially when we had them on paper docs not too long ago, right? So
Yeah.
just getting over that initial learning curve, which still wasn't a big deal. Like I said, I don't think I ever had to send more than 2 emails and pick up a phone call, and that's cool with me. That's like 20 minutes tops per investor. That's totally worth it any day of the week.
Yeah, and with investors, I mean, it's as you said, especially with your attorney hat on. I mean, people don't love spending all the time with documents. They don't necessarily like to deal with the technology. It's the managers constantly balancing, trying to do right by the investors, hold their hand, take care of them. But at the same time, you got a business to run, so it could be tough. I know you've had some other administrative experiences in the past, and they don't get name names or anything. But like, what have been some of the challenges that you've seen with administration? Because I think a lot of people, they don't even necessarily know what administration means or is or
Yeah.
does. What is your interpretation of that, and how has that worked for you?
Yeah. So I'll answer that question in two ways. First, I'd like to mention too, the whole point I mentioned like the IR team is because I have had IR members before. And at the end of the day, I still have to stand over them and kind of make sure what they're doing is proper, because now they're acting on my behalf, right? Whereas Verivest is certainly acting on my behalf, but from a third party position. So it helps fix that particular situation or gap in call it quality assurance or quality control. But anyway, specifically with other fund administrators, it was kind of from the beginning. It always felt like kind of like a money grab just to start at a high level, which was always irking. It was kind of like the better I did or the more I made, the more my fund administrator makes, which is fine to a certain extent, right? But I don't think the gain in revenue or profit should be proportionate to my work, right? It should be proportionate to the fund administrator's work. So I found in a lot of other cost structures, it seemed like, the harder I worked, the more my fund administrator got paid. And the fund administrator never really changed their level of work, their work level or their quality of service, because if they were doing it right from the beginning, right, the quality of service shouldn't really be able to go up. And maybe the workload goes up a little bit, but let's be real, it's kind of like a software system. You shouldn't have proportionate proportionate increases. You should have diminishing increases and then some type of cap. So the pay structure was just wonky in the hedge fund world. And I'm sure people who are from the fund space don't feel bad for me because everybody's subjected to that. It's kind of just the way of doing business. So it's nice to come over to the real estate side and see that everything was viewed kind of like as a project level. But then in regard to
Yeah, and
the
I'm not
actual,
as familiar in the hedge fund world exactly how all of that works, and on the real
I
estate
mean,
side.
some of them will like dock you for doing more transactions. Some will make you, some base it off your AUM, some base it off your transaction. Some do a structure where it's like, hey, whichever one pays me, the fund administrator, more. It's like, all right, what kind of relationship is this? So it was just one of those things where if you didn't have a certain amount of scale, it was really harmful to your business. And it just made it a little difficult. And then really what matters, like that's just part of the business in that industry. So that's fine. Like setting that aside, that's fine. You got to deal with it. Everybody has to deal with that. But the worst part is there's so many fund administrators, you don't know really which ones are good and which ones are bad. They're constantly being consolidated and being purchased. The one that I was using got purchased while we were actually under contract with them, which isn't necessarily a bad thing. But when you're a small client of a small acquisition, you're not necessarily getting the attention you wanted, and it's certainly not going to improve. And then past that, before they were acquired, they're human too, right? They're fallible, and they'd make mistakes, like literally sending out the wrong amount of money to an investor. Like that's the
Yeah,
worst thing in the
those
world.
are like nightmare scenarios, right? It's like you
Yeah,
don't.
they sent us. I've gotten the wrong nav before, the wrong nav calculation, which calculates to the wrong returns to the investors. And you're sitting there and you're like, what am I supposed to double check my fund administrator's work? And then in that case, why do I have a fund administrator? You're basically paying this entity for this false sense of CYA. Really, you have like this legal cover, but at the same time, you still have to actually do the triple checking now, not the double checking, because you checked it once, then you sent it to them, they check it, and now you're checking it again, which I'm sure there's engineers in the crowd would love that process. But
Yeah.
for the business people, I'm like, dude, this is so redundant, and then it's not, and then everybody's making mistakes. So
But
what
yeah,
if
that's like when I got with service. That's an issue with all service providers, right? It's like I know my
yeah,
CPA is like got a super complicated set of tax returns, and they say make sure this is right. I'm like, dude, I have
no,
absolutely like I don't
yeah,
understand this, right? And that's what I'm paying you for.
it should be yes or no questions to me as the client. Worst case, right? Is this the scenario? Yes or no? If yes, answer this. If no, answer that. Right? Like that's how it should be for a client. It ended up getting really, really discombobulated from time to time, and I was a first time manager, so I don't want to say I didn't have any cause for like I probably caused some of the confusion from time to
Yeah,
time, but it's not like I came in and said, "Hey, this is my 10th fund." It was very clear.
yeah.
Everybody was very aware. I was a first-time fund manager, so at the end of the day, and I had Dean by my side who has tons of banking experience, so he knows how to expect reporting to
Yeah.
come in. And just sometimes it was just frustrating. They'd be late. It'd be pretty much the worst case scenario: late, wrong, sending things to the wrong people. And it's not to say that people can't make a mistake here and there, but when it becomes kind of something you I don't want to say expect, but you're constantly worried about, that's when I'm like, why? Then you go back to the pay structure and you're like, geez Louise, like what am I actually paying for here?
So
um
what's been the biggest difference, man, from your perspective between a hedge fund and real estate? Like how is that? What just making the transition there? What do you perceive is the biggest difference for running a
well,
hedge fund and what you're doing now in
I
real estate?
mean, the biggest difference is the amount of transactions, right? Like that's really where this thing gets way more simple. Is when you're in a hedge fund, you're trading hundreds of securities, if not more, and each one has its own basis, trade date, all this kind of stuff, where they're making calculations on your carry. and everything gets locked in at certain dates and all that. Whereas real estate and the way we do it, it's a much more long-term investment. You're in that thing 3 to 5 years, as opposed to
Yeah.
our hedge fund, which had redemptions. I think they could redeem quarterly. I forget, or maybe it was just 90 days notice, whatever it was. But point being is the big difference was the transaction volume, and then your basis is just your basis and cost basis. Everything you add to your original purchase price is so much easier to track, right? As long as you're actually keeping track of your expenses the way a responsible operator would, like we do. It's not a difficult expense trail, if you will. And I think that's the really big difference, is just the amount of transactions and the ability to making it easier to track. But that's no excuse for when I was back in the hedge fund space, for people to make mistakes, because if you're a hedge fund administrator, you should be able to track those things. So that was easy, or that's the biggest difference. And then, the better part is, when I was getting logged in with Verivest, it was a lot simpler onboarding process for me as a client too, not just as an investor. So I enjoyed that. It felt like the fund administration that I was dealing with in the hedge fund space. Like, once you signed up with these people, you were married to them, and you didn't even get any type of real trial period. And I guess at the end of the day, you don't really want a trial period because you don't want to redo all these things. So it was just a tough situation where you kind of got to pick your horse and stick with it, prior to really knowing how they run.
Yeah. Well, Ray, before we're going to open up the floor to questions here. So if anybody's got any questions, please type them in there. Happy to do that. But maybe a couple closing questions for you is, as you look back on some of your projects here in the real estate world, what are some of the biggest lessons you've learned so far, and anything you might, change or do differently as you made that transition?
Yeah. So, specifically to while I've been operating in real estate, or the transition?
Yeah, well, let's just say as you make the transition into real estate, and
Yeah.
what you've learned about real estate and how it's different, and just maybe things you didn't. I always find that, you go into something new, you have preconceived notions about what it is, and then you figure out that, okay, maybe I thought it was going to be like this, and it's not.
Mhm.
Any just big lessons that you've learned, or things that you might impart to the audience?
Yeah, patience is definitely the biggest lesson I've
Real
learned.
estate real estate moves pretty slow.
Yeah, it's not a get rich quick, but it can be a get rich for sure if you do it right. So that's kind of how I look at it. And really, the biggest lesson I learned aside from patience was just truly be value oriented and risk oriented. I mean, at the end of the day, you know, the tried and true lessons of real estate never change. Like, locations, it will never change. It's the most important thing about an asset. Second most important thing is your basis. Your money is made on the buy. You're never gonna change your purchase price after you buy something. And then, kind of from an operator standpoint, from being a young business leader, everything everything you think can go wrong, but it's the things you're not thinking about that are going to go wrong, that are really going to get you in trouble. So it's always interesting how, every stone needs to be unturned. And I know these are all things that everybody told me before you start, but it's one of those things that not until you experience it, where the smallest molehill becomes a mountain in the way of your entitlements, or your process, that you're like, wow, I really wish I had experienced that before. And um, really, the only way you get better at real estate development is going through it. I mean, you cannot read about this stuff. I mean, you can, and I like I said, I went to law school. Like, I get it, from a legal standpoint, and I get it from a business standpoint and business plan standpoint. But the execution on this is more persistence and grit and vision than I ever thought it would be. And I will say that, my ignorance in the beginning was probably one of my greatest strong suits, as well as one of my biggest, liabilities. Because I think if I understood how much went into being a real estate developer, and how much went into, getting something entitled, and just going through a full cycle deal, I probably would have ended up in, like, the value add space, and I probably would have been upside down too, because I would have bought assets in the past few years with floating rate debt, and I'd be trying to refi in the past 12 months. So, um, anyway, we talk about it all the time here. It's like hindsight is for sure 2020. You just really don't know at what point in time you're actually seeing 2020 when you look back. You may think you should have been a value add operator a year into your business, and then you realize 2 years later that's a bad idea. You might have thought you should have maybe leveraged some of the land you bought because you got a great basis in it, and then you fast forward, you realize that would have been a terrible idea. And you wish you would have gotten out of the ground quicker. Then you fast forward and you realize, hey, that means you'd have been COing at a much worse time in the credit cycle. So, as much as I hope when I look back, I say that I was skilled and everything, it really is kind of a matter of pivoting and doing what you need to do to navigate the market. And just like I said, being value and risk oriented so you don't run into a burning building. That's what a lot of these developers look like they're doing sometimes. Or value add operators. They're buying something just because they have that pool of funds, like we talked about, which will make you do things you won't normally do. They'll go buy something and realize, we'll figure out the debt refi, or we'll figure out the
Yeah.
exit in 2 or 3 years, and a year and a half, 2 years later, somebody's changing the credit cycle on you completely. So ignorance is a liability, but at the same time, it can also be a strength if you're operating with the right principles in mind.
There's a lot to unpack in that set of advice, man. So yeah, thank you for sharing. So what are you looking forward to for you and Southern Waters here coming up? Anything exciting going on that you're
Yeah.
particularly pleased about?
Yeah, we just put a deal under contract in South Carolina. I'm super excited about. It's a really big project, a little bit over 300 units of multifamily, 32,000 square feet of commercial, and 130 units of senior. Um, we're
That's big.
working on Yeah, we're working on some off-book land development deals for national home builders that are really tough to pull together, but once they get together, they'll be really great. So we don't have one of those under contract yet, but working really hard, got some offers out, and we've been having some deep discussions. And then I just got entitlements on a few of my projects, and we're hoping to come out of the ground sometime in late Q1, between late Q1 and early Q3 of next year on a couple things. So hopefully we'll be delivering in that window of late 20, like mid 26, 2026, where we think there's going to be a lot of lack of supply due to the slowdown in building that's been going on the past year.
Yeah.
So I'm just super excited about my pipeline coming out of the ground, seeing progress, and then we're adding to it very responsibly. We're not trying to rush and put a bunch of stuff under contract that we know would probably be better priced in 6 to 12 months. So for me, it's really tending to the pipeline that we've been lucky enough to put together over the past couple of years, and making sure that everything goes the way I promised all my investors. So
Yeah, that's the key. Trying to do the best you can to do that. It can be very hard depending on changing circumstances, but that's the goal for sure, right?
yeah, if we go full cycle in a market like this, in a few years, I'll look like a pretty good developer, as opposed to if I only come out of the ground with half my pipeline. So my
Yeah.
goal is to make sure everything I made a bet on is a winner, and as much of a winner as I can make it.
Yeah, that's good. So, all right, well, Ray, appreciate that. So let's take a few questions on it. Kylie, do you have anything on the Q&A that you can share with us, or for me or Ray?
Yeah, I've got two good ones. The first one's for both of you. So finding the right investors and sourcing new deals while running the business can be demanding. What advice do you have for striking a balance between that day to day and expanding your portfolios?
Matt, you want to go first?
Go ahead, Ray.
Okay. Okay. So splitting the time. Um, I always like to say, like, I'm a religious guy. So really kind of God brings opportunities to me, whether it's dollars or dirt, and it's up to me to recognize them and run after them and prioritize them. So as much as I wish I could say I allocate X amount of time to this and X amount of time to that, what I'm really doing is I'm always looking for opportunities in the land space. So I'm constantly doing that. And then as I start to acquire more opportunities, I'll start to raise money as those opportunities start to come to a point. Basically, we'll spend the first, 500 grand worth of pursuit capital. By the time I spend like 100 grand, I kind of know I want it, and I kind of know it's going to work. And I think it's time to start revving up the actual raise for that asset. So I'm definitely a dirt guy first. I find the dirt first. I analyze it. I do a little bit of improvement to it. I secure it. I make sure I like it. I make sure I'm willing to bet on it, and I put my money in it. And then I turn around and I start to raise money. Now, what happens is raising money is something where I have like, a network of people, and then there's some people that are 2 or 3 degrees separated from the ones that I already know. So after you reach out to your initial, call it corpus of investors, they you kind of let it settle for a little while, right? And as it's settling, I'm out looking for more dirt. And the second I get a response, I'm focused on the money. So I mean, I'm doing them both at the same time, and a lot of my work is done from the car and from the phone, and I only have a laptop. So I'm constantly running around, and I would say that my time is split now, kind of 65 or 70% on capital, and more like 35 to 30% on dirt. And it was flipped the other way around probably a year ago. And that's kind of where I'm at now.
Yeah, and I think a lot really depends on the manager in terms of, is it a fund, is it a syndication, the way in which you raise capital and divide your time between deals and capital can vary depending on volume, how many deals you're doing, what kind of deals you're doing, if how complicated or not they are, what kind of an entity you're raising it for. So there's a lot of variables. So I would say that the most successful managers that I've seen over the years are people that have more than, they're people who have been a divide and conquer. So you have some folks that are focused largely on the deal side and others that are focused on the capital side. And when people wake up in the morning, they're spending time on one or the other. Certainly lots of people end up having to spend time on both. And even if you have multiple principals, you'll invariably end up spending time on both. But the degree to which you can have some division of duties and or primary responsibilities and split them up, I think those people will generally tend to raise more money on a business that's scaling. So
yeah, and to that point, I mean, to piggyback off that, you're completely right. So I was just reading this book called Traction, and it's funny. The author mentions how businesses are all businesses are split into 3 sections. You have like sales and marketing, operations, and then finance and administration. I'm certainly the sales and marketing to a T. I mean, I'm the top of the funnel, if you will. Andrew Sinclair, my dear friend and business partner as well to Dean and myself, is a background in construction and is a project manager and a MSF, a master's in finance, really smart guy. So once I get something secured, I mean, look, I hate to say it, but I could easily be run over by a bus, and Dean and Andrew can handle the actual process of getting the deal to the finish line, and I can go focus on marketing and selling the deal itself. Now I'll stay on top of the whole process the entire time, but to Matt's point, yeah, once something gets to a certain stage, I can kind of hand it off, and then I'm coming in and really liaising the relationships more so than actually hammering away at the day-to-day activities. So it's certainly a divide and conquer effort. I'm not doing everything. I got a team of like 5 of us who definitely help me get everything done. I'm the tip of the spear.
yeah. So Kylie, you said we had one more question.
Yeah, this question's from Donna. Thanks, Donna. What are some of the ways you research to find your land deals?
Yeah. So really, people they think it's really complicated, but I just use Google Earth. People think I have like all these crazy programs and everything, but at the end of the day, I find a market with a fundamental imbalance in supply and demand. I like the job growth there. Once I basically convince myself I like a market, I go on Google Earth, I go to the major thoroughfares, I look for blank land, or I look for assets I know or parcels I know I could assemble. And then whenever I want to get a hold of them, I also use Google and I reverse look up whoever owns the home, or if we have to, we'll knock on the door, we'll do whatever we have to do. Sometimes a broker ends up in between me and the landowner just because the broker knows the landowner, or maybe they were representing it, but it's not exactly how I got in touch with the landowner. But no, it's a total Google search, and I wish there were brokers out there who could bring me deals. So anybody listening right now, feel free to bring me any assets that fit 300 units of multifamily or 100 units or more built to rent. I will certainly take a look at it. But truly, It's just being a being a persistent search, being on a persistent search all the time. So that's really how we do it.
Yeah, write it out, right? Kylie, any other questions, Kevin?
Yep. Yeah. One last question and then we'll let you wrap it up. One from John. What specific areas or regions is Southern Waters Capital focusing on for the conversion of obsolete office buildings, target former banks into multifamily or adaptive reuse, and any trends you see emerging as we settle into post-pandemic world opportunities?
Yeah. So the office comment. I wish I could tell you I was doing that. I'm really not. When I would hearken John out there, do some. There's some really cool like YouTube videos and some articles out there that talk about the natural constraints of office floor plans, everything from elevator banks to depths of the floor plate that makes it a little bit I won't say impossible, but cost just inefficient on a cost level to convert some of those buildings. So really on the office space, I think I have a lot more learning to do before I jump into that. If I were gonna do it, I'm hot on any market in Florida that's an actual metro. I prefer the Mid Atlantic states as well as Tennessee. I know Texas is an awesome market, but I really just don't understand it at this point. I also haven't taken the time to really dive into it just because it's so competitive over there. So for general markets, for me, it's the Mid Atlantic, Tennessee, and Florida. And then in regard to the bank thing, it's funny that's brought up. That the bank portfolios are super interesting because there's I don't know if it's an antitrust law or what it is exactly, but I remember when Truist was created through BB&T and SunTrust, the bank itself didn't actually know which assets it was going to be able to or going to have to sell because they can only have a certain amount in one area due to monopolistic tendencies or factors or whatever it is. So what's really frustrating is there's tons of opportunity, and I know exactly what John's driving at, and it frustrates me because I know there's office buildings to be converted. I know there's bank assets that should be sold off at great rates. It's the amount of time you have to spend to actually dig up one of those opportunities, and then you have to weigh it against the probability of the opportunity coming through. And it stinks because it's just not on it from a time perspective. It's not something that I can dedicate a lot of time to. So I guess my last comment would be whoever out there does have the time to dedicate to that should certainly bring those opportunities to people like me because we know it's there. We can understand it once we see it. It's just a factor of time. I can find a lot more opportunities on greenfield land than I can those types of unique redevelopments, even though those unique redevelopments could lead to trophy assets one day. So you've hit on a nerve, John, that makes me upset. But
Yeah.
I wish I could do it more.
John's following up on retail to Target as well. If you have any ideas about big box retail to Target.
Yeah, I mean, they're out. I mean, so it's the same story, but with a lot less of that bank factor that I mentioned to you. I think those retailers, most of them are going through an actual bankruptcy, which would require that Dean, who's sitting behind me, has a lot more experience in the bankruptcy courts and those types of proceedings. So I wouldn't be surprised if those assets get sold off in chunks as portfolios because they have to do what's best to recoup for the investors, and doing it in a one-off fashion isn't going to do it at the speed that they need it to get done. So the answer is once again like the time and the effort it takes to lock one of those in, and honestly the ability to negotiate with the trustee of a bankruptcy proceeding when you're only going after one asset, it doesn't put you at the top of their priority list. So it'd be easier to probably buy some type of corporate debt attached to it and just foreclose on that than it would be to probably negotiate with the trustee. Um, but you're right. Again, those are all assets that need to be redeveloped. But some of them, I think, will find some pretty creative uses, whether they get turned into smaller fulfillment centers or whether they're turned into smaller. I doubt data centers because those require a lot more infrastructure and power, but a lot smarter people than me will be able to redevelop those assets. I don't think in the state of Florida you're going to have a lot of warehouse to condo redevelopment like you do in other cool cities. But that's kind of that's my thought on that. But I look at it as land. So if there's 5 acres somewhere near a metro, I mean, I want it. So I know there's value there for sure.
Yeah, we've had a fair amount of experience with the repurposing big box retail and done a bunch of storage and some other things there. So there's a lot of different uses for it. I think that's morphed a lot.
Yeah,
over the last-
storage is definitely one of the, I mean, everybody knows how hot storage is. I personally, this is the only thing I think I have in common with Warren Buffett is I really only invest in things that I use and understand on a daily basis. And storage has never been one of those for me. I throw stuff out before I put it in a storage unit. So I've had trouble wrapping my arms around the storage business model. Yeah, but I know it's valuable. But if you walk around and talk to a bunch of 30-year-olds like me, the only ones who have storage units either just had some weird big move or whatever. They don't have like a bunch of furniture things waiting for their home that they're gonna maybe buy one day and put it in there, or baby stuff or whatever it is. Usually their storage unit is from, unfortunately, like a late relative or something like that, or they're going to transition.
All the shit they inherited from somebody else that they really don't want.
Yeah, maybe they'll turn into affordable housing one day with no windows, but I don't know. But storage definitely has a long runway. But I'm here to say that I don't know if storage will be the way it is for I don't know. I think it'll be a different in 10 years. I think it'll.
All right, Ray. Hey, it's been a great having you on, man. As Ray's been a great client of ours on our fund admin business, and got a lot of value from it. And I appreciate you coming on board, Ray, and the show today, spending some time with us. So thank you very much for being here.
Pleasure's mine. Thank you. I appreciate it.
All right. Well, all you folks out there, thanks for joining us today. We really appreciate it. If you get a chance, you want interested in how Verivest might be able to help your business, setting up funds, doing administration, etc., on our website, you can book a demo. You can also sign up for our newsletter. Please go on there. And if you found today's conversation valuable, I hope that you take some time to check out the website, see what we got going on, and see if we can help you in your business, help you grow and scale a real estate asset-based fund and strategy. So thanks very much for being here. Have a great rest of the day.
Take it easy, everybody.